Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. I want to bring in Mohamed El-Erian of Queen's College, Cambridge. Mohamed joins us now. Mohamed, you've had a few minutes to go over these numbers. Your initial reaction, and then we can get to the much, much bigger picture going forward from here.
So while I agree generally that this is not as relevant as it normally is as an employment report, I do focus on the 0.3% monthly earnings growth. When people rush to predict lots of Fed cuts, they forget the difference between what is necessary and what is necessary and sufficient. Pronounced weakness in the economy is necessary for the sorts of cuts that are being priced in, but they're not sufficient. The Fed needs some sort of air cover on inflation. And most forecasts of inflation, as Jeff said, are now going to the 3 to 3.5% at the PCE core level. So this is quite a move. The 0.3 monthly earning growth that we saw in today's report is not consistent with air cover on inflation. So this is a report that suggests to the Fed, wait and see. And my hope is that Chair Powell, later this morning, will do two things. He will walk back the notion that the tariffs' impact on inflation will be transitory, and let's eliminate that word again from his vocabulary. And the second thing I hope he walks back is the ease with which he dismissed the soft data. Because, as Stephanie said, expect the hard data to weaken in the months ahead.
Mohamed, are we dismissing the strength of this labor market report at our own peril? The idea that corporate America has thrived despite what the U.S. government has occasionally done, and that there is quite a bit of robustness and people who are employed and able to absorb a greater amount of price increases that might get passed along to them?
I think, Lisa, what this reminds you is that the structure of the economy is fine. And this is important because while there is general agreement on a very bumpy few months, there's significant disagreement on where this would lead to. There are those who think that the pain is worth the gain that's coming forward. It's just a matter of time, and the structure of the economy is strong enough to take us through this very bumpy journey. And there are others that worry that the structure of the economy is not as strong as we think it is. This number here gives you some confidence that the economy is fine if we can just avoid repeated self-inflicted wounds.
If you are just joining us, welcome to the programme. Moments ago, a big upside surprise on the payrolls report, 228, the estimate 140. And we look at the charts. In the immediate aftermath of that jobs number, this market hardly blinked. Yields are still down 15 basis points at the front end of the curve, 352. And in the equity market at the moment, equity futures are lower by 2.8%. Mohamed was looking forward to Chairman Powell at 11:25, and Stephanie Roth, he talked about that word transitory, the T word. Does that get canned today?
I would imagine he won't use it again. I guess, of course, we'll see. But I think we'll have to be a little bit more cautious about this. And I think it's also important to think about the fact that transitory doesn't mean the same for every person, which is the problem. And the extent of the tariffs are so big that it might take a really long time for this inflation shock to work its way through the economy. So yes, it is.
The T word, as you know, speaks to the same mistake we all remember, which was waiting too long. That's the problem with the T word at the moment. Waiting too long to do something about inflation. This time around, I wonder, conditioned by their previous experience, do they wait too long to do something about growth and downside risk to growth? Because that's the major risk for this market.
Yeah, I think that's potentially the case, and they're going to have to wait and see. And by the way, they're going to be watching inflation expectations. They've anchored, especially the last time in 2018, they said inflation expectations were the main anchor to determine whether they can look through it or whether they have to act more hawkishly as a result. And if inflation expectations start to pick up, they're gonna be in a tough situation for a little while. They're gonna have to wait until things get really bad before they can act. And by the way, inflation expectations, long-term ones, are largely driven by your most recent experience with inflation. Well, in 2018, we had no inflation in the past prior years. This time it's very different. And inflation expectations are likely to pick up a lot more given experience with inflation and the fact that these tariffs are just so large.
Which raises the question, Jeff, and I would love your thoughts on this, how the bond market responds to either a dovish message from Fed Chair Jay Powell or a hawkish message. If he does put transitory back in the bottle, does that give you more confidence, frankly, to go into long-term bonds? Because eventually they might have to cut rates a whole lot more.
Yeah, it's really interesting if you look at the last 2 days and what has transpired in terms of the bond market. So yesterday, you saw a big rally in rates, but it was mostly led by the intermediate and short end. If you look at the 30-year portion of the curve, it lagged. For a brief moment in time, it barely budged at all. Contrast that to today. And today what you're seeing is a very different picture from the bond market. And probably the most striking is that you're seeing not only longer-term inflation expectations fall, but even some of the shorter-term inflation measures. And so Stephanie was just talking about it. It'll be challenging for the Fed because it depends on how you're measuring inflation expectations. Everybody's seen the Michigan survey. The survey measures will likely be going higher in an environment where people are seeing higher prices due to tariffs. Potentially that gets a little bit offset by what we're seeing in oil, but the impact in terms of survey responses may be to higher inflations. Meanwhile, in the bond market, they're really looking at the financial conditions tightening that's going on, seeing the implications for consumption. 70% of the economy is driven by that side, and that's quite negative, and starting to price in today much more of a deflationary environment. So you're seeing the back end of the curve fall, you're seeing break-evens fall, and you're even seeing short-end inflation measures, which have really been this story about stagflation. When you measure the stagflation, it's short measures. Inflation in the near term is expected to go up. Now some of that stuff is starting to get rolled over. So it's possible here the bond market may try to lead the Fed to this message of transitory by basically cutting the interest rates both in real and nominal terms for them.
I can tell you this market move's not leading the president to changing his mind. Just posted on Truth Social right now saying that my policies will never change. If you're looking for someone to blink this morning, it's not the president at the moment.
He says to the many investors coming into the United States and investing massive amounts of money, my policies will never change. This is a great time to get rich, richer than ever before, which raises this question of how much the bond market and the stock market matter to him at a time where there is real concern on Wall Street that isn't being reflected in his commentary.
Jeff mentioned crude. Crude is down by 7.5% on WTI. Brent is down by close to 7 full percentage points. Mohammed, quite clearly, this is a shock to the cycle. Quite clearly, we're repricing growth lower. From your perspective, how much of a shock to the system is it, and how long does it take to internalize major regime changes like the one we might see?
So, John, we are repricing growth outlook in a significant manner. Interestingly, the beta for the rest of the world is catching up. It started out being a U.S. phenomenon. Now it's spreading. People are realizing that if the U.S. growth rate falls by X, it may fall then by more than X outside the U.S. And I think that is correct. The beta is greater than 1 outside the U.S. So it's a major revisiting of the growth outlook. How long? It depends on what other countries decide right now. The president's message will encourage other countries to retaliate. You see, there's a choice out there between retaliate, de-escalate, or just wait. And we all want de-escalation, but the escalation requires both sides to play along and for there to be an amount of trust that this is not a multi-round where you're going to have to renegotiate every time. If you de-escalate now, it will hold. That isn't there right now. So I suspect you will see more countries move towards what China did, which is a response that involves both tariffs and non-tariffs. And where that comes in for the bond market is we're now going to start talking not just about interest rate risk, but credit risk in the bond market. Credit risk has been, until very recently, really well protected, but now we're starting to see it come under pressure. And credit investors no longer have the shield of all-in yield because both components now are in play. So the next thing to look in the bond market, John, is going to be not just at government bonds, but look at credit, and in particular high yield, because that is significantly vulnerable right now.
Yeah, we saw yesterday the biggest spread widening going back to the heart of the pandemic in some of those riskier instruments. We caught up with you earlier this week, Mohamed, and you said that it's about a 50-50 chance, in your estimation, that we either have some sort of Reagan and Thatcher-esque reordering of the global trade system, or you go back to the 70s, you go back to Carter on steroids. Do you still think it's 50-50?
I do. What has changed, if you remember, I said my own perception is 50-50. The market is at 80-20. The market is absolutely convinced this is a Reagan-Thatcher moment. I think that 80 has come down in the last couple of days, and for good reasons. So yes, I'm still at a 50-50 because there is the upside of significant innovations in tech that are there that are multi-year beneficial to productivity. So yes, I'm still 50-50. The market is repricing now closer to 50-50, which is, I think, that's the correct thing for the markets to do.
We can add to that. I think there's a lot of faith at the moment, based on the conversations we've had so far this morning, Lisa, that many people still don't believe these tariffs even go on, and if they do, it won't last long. We've got these two key dates now. April 5th is tomorrow, so that's the baseline 10% tariff. April 9th is when you hear the 20 on the EU, 24 on Japan, 34 on China, and the big numbers on everybody else. Everybody thinks that we can negotiate something in between. I think they're scared at the moment that we won't, but if you go through all the research on Wall Street right now, the base case is this won't happen. And I wonder where that faith comes from.
At a certain point, there was this belief heading into this year that the Fed put was there and that the Trump put was there. To imagine that an administration would allow an economy to tank or a market to tank seems infeasible, and I think that's what a lot of people are looking at. If you put on top of that this question of where is the off-ramp for the tit-for-tat retaliation, how do we start to estimate the damage from that? It becomes a fool's errand to try to model out, and I think a lot of people are just saying, look, we're just going to assume that's not going to happen.
Jeff, where does that faith come from in the market right now, that it's so bad it just won't happen?
I think, as you're pointing out, that faith, or as Mohamed was pointing out, I think that faith is being challenged day by day, and I think that's why you're seeing the market reactions. So I think the only path forward is to observe what this administration and the policies that it chooses to implement are. It's very impossible to forecast, but the 80-20 to 50-50 I think is right, and you see it in these market reactions.
Stephanie, how do you model this?
So we've definitely tried to model this a number of different ways. Base case is we've done the fool's errand approach and tried to model from a global perspective. What happens if we apply all of the tariffs? What happens if everybody else retaliates in kind, and then you get some offsetting factors? The numbers are kind of comically bad. You're looking at something like a 2 to 3 percentage point headwind on GDP if this all really plays out. Again, we don't think it will play out to that extent. We think it will be pretty severe, which is why we took our growth estimates down for this year to 0.5% and recession odds up to 40%. Because these policies are bad, and it's hard for the administration to walk away from it unless something forces them to do so. And we're not there yet.
Stephanie Roth of Wolfe Research, a special thanks alongside Jeff Rosenberg of BlackRock. Mohamed, I just wanted to give you the final word before we go. What you'll be looking for going into the weekend, and as we reset, going into next week, what's the number one thing at the top of your list?
Number one is listen to the administration. I think there is a belief that you may have to break some things to remake the global order, but remaking the global order is the objective. And you have the very specific example of X, where you had to break things to remake it at the back of people's mind. But also listen to business. And I've been on the phone nonstop with business leaders, and they are not waiting, John. They see a hit on the cost side. They're worried about demand destruction on the revenue side. And they're starting to make difficult decisions about the balance between profit margin compression, higher prices, and cutting costs. And these discussions, believe me, are really active. Business is not going to wait because they're going to try to rebuild resilience, because whatever people disagree on, I think most of us agree on this being a very uncertain environment.
Mohamed, appreciate your time, sir. As always, Mohamed El-Erian there of Queen's College, Cambridge. With us around the table, Michael Zezas of Morgan Stanley. Michael, good morning.
Hey, good morning.
This is tough. For a lot of people, it's so bad it just won't happen. Is that your position on things?
Well, I think there's probably plenty of room for negotiation. We just don't know what the parameters are, right? So one would expect that lower tariffs, potentially asset purchases, potentially more military spending in some of these situations might help. But really, we're in this discovery process right now of what the sufficient conditions are. Unfortunately, and I don't think this will clarify anything for anyone, there are probably different conditions for different countries. So we shouldn't go into this, at least from my perspective, thinking that any of these negotiations will go quickly or any of this tariff relief will come about quickly. And so we do need to price in at least most of the negative consequences of these choices.
What is the significance of the formula that this Trump administration used to come up with the tariff rates on each country?
Yeah, I mean, I only know what they've told us, which is effectively that it's supposed to be a representation of the trade deficit, and that in a theoretical world where if tariffs are equalized, that there would be no goods trade deficit. That said, I don't know if the information we're supposed to take from that is that their end goal is to just get goods trade deficits down to zero, or if just that they apply the methodology and they're willing to talk about it. Again, I think we're in that discovery process over the next week. But either way, it doesn't seem like we're going to get relief quickly from any of this.
I was speaking with an investment manager yesterday, and I said, what is your methodology of taking all of the data that we're getting it and ranking it, et cetera? And they said, I run a lot. I run frequently. What on earth are you telling your clients?
Yeah, I mean, listen, I think what we said coming into the year was that we did think that higher tariffs were going to be a fixture of the U.S. policy posture. We thought it was going to be mostly aligned with China, and kind of rest of the world would be a lighter touch. I think that's still generally true, but the China tariffs happened faster than we thought. We did think they'd get to 60%, but we thought that was kind of an early 2026 event. And rest of the world would sort of be product by product and lighter touch. So the new thing we have to bake in here is rest of world tariffs are higher. There's at least that 10% minimum, and then there's higher levels on top of that. Maybe some of that gets negotiated back. But that means there's a weaker growth outlook than we would have anticipated. So now we have to price in weaker growth, higher recession probability, and unfortunately, I think most risk markets just aren't priced for that reality yet. Some of the stuff becomes positive catalysts once you've priced that in, but we're not quite there yet.
Do you entertain the theory that this was about getting the bad stuff out of the way, getting rates down, getting bond yields below 4%, down towards 3%, before they come out with a massive tax plan? Do you entertain any of that?
I tend to look at this more as it was a sequencing of what was available to them politically and sort of legislatively going into this, right? So, because you could sort of make a theory that, hey, why don't we just do the tax cuts first and create space to operate and incur some of the pain around tariffs in the effort of kind of this grand remaking of the economy.
That's what people hoped for.
Right, but I think practically speaking, the ability to actually extend tax cuts and or do more wasn't going to be on offer early because you had to work through the budget reconciliation process, really slim majority. So you work with the things that are in executive control, which is tariffs, because that's open to you. And the legislative stuff was just always going to take longer. So I don't know if there's a lot of rhyme or reason to it other than the administration's doing what they can do with the tools they have available in service of their medium-term goals. And this just happens to be the sequencing of it.
The challenge at the moment for a lot of us is to kind of put markets to one side and think about where we'll be 12 months out.
Yeah.
In 12 months' time, when you've got your hands around the more complete policy platform, not just trade but taxes as well, what's the mix going to look like?
Well, listen, there's two ways to think about this. It's like, are you better off 12 months from now than you would have been if these choices haven't been made? I think that's an open question, and I think answering that question isn't necessarily relevant in the sense of the real question is, can we price in the kind of negative effects of making these policy attempts? And once you've done that, can the policy choices you make to kind of ease that get it better? So if we were to kind of fully price in higher recession probabilities, weaker growth outlook, and then some of these negotiations on tariffs work out, and then maybe we get a bigger tax cut than we anticipate, because right now we think it's going to be mostly an extension of the TCJA. Those things can be positives on top of pricing in negative outcomes, but I think we have to go through the pricing in negative outcomes first.
Yesterday there were a lot of historic kinds of comments, a lot of catastrophic rhetoric, sea change, the loss of U.S. exceptionalism. Did you take comfort in the fact that Treasuries rallied, and John mentioned this earlier, that even though people were talking about boycotting U.S. goods or boycotting the U.S. dollar, you did see yields go lower as a haven trade?
I mean, so obviously an incredibly large and liquid market, and it makes sense that in times of uncertainty where growth expectations are weaker, that you would be buying more Treasuries. I think that to us was sort of never in question. I know there are sort of hypothetical longer-term concerns, but that's why we've had this preference for fixed income over equities coming into the year and then throughout all of this. I think that's still the way to be positioned right now.
That's the silver lining for me. I know it wasn't your base case, but I'd be extremely worried if we woke up one morning and you had all those people that were running around saying, we're going to see an exodus of money from the United States. People are going to dump dollar-denominated assets. They're dumping equities because that's associated with growth. I don't think there's a sign here that they're dumping dollar-denominated assets because of the policy volatility, because that would show up in Treasuries too, and that is what would really concern me. And that's the silver lining, I think, from the cross-asset price action of the past 24 hours or so.
That at least the United States is not acting like an emerging market in this respect, because that's exactly what we would see.
You saw the dollar weakness, but the dollar weakness accompanied with a bond market sell-off would be getting my attention in a much more negative way, and I think it would get the Federal Reserve as well.
We're far way away from that, and the United States still is the dominant market, which goes to this idea of how do you get perspective at a time of a lot of superlatives.
Let's hope we never see that.
Yeah.
Let's be very clear about that. Michael, thank you, sir. It's good to see you. Michael Zezas there of Morgan Stanley.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.